Welcome back. Today, we are diving deep into the reasons behind sharp decline in Indian stock market. We will look at the key factors from economic slowdowns to global market impacts and break them down with data and trends you need to know. Stick with us until the end for a comprehensive overview and insights into where the market might be headed. First up, let's talk about India's economic performance over the past few years. While the country has seen impressive growth over the past decade, recent data points to a slowdown that's weighing heavily on investor sentiment. As you can see in the chart, India's GDP growth took significant hit during COVID-19 pandemic, with a contraction of nearly 24% in quarter 2 of 2020. However, the economy bounced back quickly in 2021, with a strong 20.1% growth in quarter 2 of 2021. But since the second half of 2023, growth has been tapering off. In quarter 3 of 2023, the economy grew only by 4.5%, a sharp drop from 6.1% in quarter 1 of 2023. This slowdown is a direct result of reduced demand, higher inflation, and slowing global trade. It's a major concern for investors who were used to rapid growth in the past. Another key factor is the massive outflow of foreign institutional investors or FIIs from Indian market. This is a big red flag for the market's future direction. Looking at this chart, we can see the trend over the last few years. In 2021, India saw $20 billion in FII inflows, but that quickly reversed in 2022 when the market saw $10 billion outflow. Fast forward to 2024 and 2025, the outflows have continued to accelerate, with $7.5 billion leaving the market in first 2 months of 2025 alone. So, why this is happening? Global factors like inflation concerns, interest rate hikes, and a stronger US dollar have made emerging markets, including India, less attractive for foreign investors. One of the biggest reasons for the recent market decline is that the Indian stock market had become overvalued. When valuation rises too high, corrections are inevitable. Let's take a look at historical PE ratio of Nifty 50 and Sensex. In early 2024, the Nifty 50 PE ratio touched 24.5x, significantly above the historical average of 19x. Similarly, Sensex was trading at PE of 25.2x, far higher than long-term median of 20x. Such high valuations indicate that stocks were priced for perfection, leaving little room for further upside. But here's the key issue. While stock prices were rising, corporate earnings were going at the same pace. The earning growth of Nifty 50 companies was just 7% in financial year 2023-24 compared to stock market rally of 15% in the same period. This disconnect between earnings and valuation make market correction unavoidable. Where valuations run too high, even minor negative news like the economic slowdown or big corporate earnings can trigger a sell-off. And that's exactly what we are seeing currently in the Indian stock market. Trade restrictions and tariffs are making it harder for India to sell goods internationally, putting pressure on stock prices, especially on export-driven sector. This chart highlights the decline of India's steel export to the US. In 2018, India exported $5.4 billion worth of steel, but by 2024, this has fallen to only $3 billion. Protectionist policies and tariffs are directly responsible for this decline. Recently, the US government imposes 25% tariff on steel and aluminum imports, significantly impacting Indian steelmakers. Smaller producers are particularly vulnerable. facing increased competition from cheaper foreign goods diverted from other markets. This had led to decline of domestic prices and potential job cuts within the industry. Major companies like JSW Steel have already reported significant profit drops due to these changes. The impact isn't limited to steel. Other industries such as textiles and electronics are also feeling squeeze, adding further pressure on the market. Adding to the uncertainty, the US had recently imposed 25% tariff on imports from Mexico and Canada, and additional 10% tariff on goods from China. These actions have disrupted global supply chains and highlighted market volatility, affecting investor confidence worldwide. Ken Griffey, the CEO of Citadel, criticized tariff policies, labeling them as a threat to economic growth and global trade alliance. He emphasized that the aggressive trade measures create uncertainty for multinational companies, complicating long-term planning. This development have led to increased market volatility, with investors expressing concerns over potential for global economic slowdown. The interconnected nature of today's global economy means that trade tensions can have far-reaching effects, influencing markets and economics. Moving on, let's talk about corporate earnings. A slowing economy and rising costs have resulted in a weakening profit margin across various sectors. This chart shows the drop in the profit margin of some key sectors. In the IT sectors, margins have fallen from 15% in quarter 1 of 2021 to just 6% in quarter 1 of 2024. Consumer goods, FMCG, a major part of India's market, has seen a dramatic decline of 11% in quarter 1 of 2021 to 1% in quarter 1 of 2024. Additionally, the metal sector, which once was booming, has gone from strong 15% growth in 2019 to a 3% decline in 2024. These declines have signaled that even India's strongest sectors are under pressure. The Indian rupee's depreciation is another significant factor impacting investor sentiment. From 70 rupees to a US dollar in 2019 to 87.95 in February of 2024, the rupee has depreciated sharply. A weaker rupee means more expensive imports, rising inflation, and decreased foreign investment. A rupee has weakened from 82.4 in July of 2024 to 87.5 in January of 2025, a 6% depreciation in just 6 months. A weaker rupee reduces the dollar values of FII's investments, making Indian equities less attractive. If the current trend continues, we could see the rupee hit 90 to a dollar by March or April 2024, exacerbating the economic challenges for India. Take a quick look at global liquidity tightening. The US Federal Reserve's interest rate hikes are a big factor in this. Since 2020, the Fed has gradually increasing rates. In January of 2024, the rate was 4%, and it's expected to rise to 4.5 by Feb or April 2025. This rate hikes tighten global liquidity, making emerging markets like India less attractive for capital flows. The comparison of US and Indian bond yields also shows why investors are pulling money out of India. The 10 years US Treasury bond yield has rises to 4.2%, comparing to 7.3% in India. Investors are increasingly favoring safer, high-yielding options in developed market compared to countries like India. So, as you can see, the Indian stock market's decline is a result of several interconnected factors: an economic slowdown, foreign outflows, global market challenges, corporate earning struggles, a weakening rupee, and policy uncertainty. With all these factors into play, the Indian stock market may face a challenging year ahead. But as always, with challenge comes opportunity. How will India respond? Only time will tell. Make sure you are subscribed for more updates and analysis on Indian economy and global trends. Thank you.